The IMF is warning that the world is sinking in debt. The fund says 8 years after the global financial crisis, economies around the world are experiencing a debt hangover of unprecedented proportions. Gross debt, for example, in the non-financial sector has more than doubled in nominal terms since the turn of the century. It reached $152 trillion last year, and it's still going up. Now, that figure includes debt held by governments, non-financial firms and households. Current levels sit at about 225% of global GDP, and that's a world record. According to the IMF, roughly two-thirds of these liabilities reside in the private sector. The remainder is public debt, which has gone up to about 85% of GDP from under 70%. Let's get the latest details on the Global Financial Stability Report that came out a little earlier today. Daniel Renges joins me now from Washington to go over it. Daniel, one of the things that cropped up in this report is this rise in, quote, populist inward-looking policies, according to the IMF. So far, though, it's been concentrated mainly in advanced economies. But from the fund's perspective, what's the contagion risk posed by that to developing economies like those here in sub-Saharan Africa?
I think there are two major scenarios. One is that there are specific contagion risks that we've seen recently, for example, with the Brexit vote, because South Africa in particular is exposed to the UK economy, then there are clear linkages there. It also, quite interestingly, raised the scenario of if the US were to erect trade barriers with Mexico, that would have a major impact on Mexico's ability to continue its manufacturing boom. So those are the sort of mildly contained scenarios that are quite realistic to the current situation. But then it goes on to say, if there was a sort of protectionist contagion that went across the world in which a lot of governments adopted the same kind of bringing down of the barriers, anti-globalization sentiment, then everybody, all the ships on the sea would all suffer. That's according to the fund's view. So I think there is certainly a level of risk at the moment that is contained, but the IMF is definitely warning governments and politicians and the electorates not to go down that route.
Indeed. Let's focus on one particularly relevant scenario, especially what's happening next month. With respect to the US election, would either President Clinton or President Trump, as the case may be, retain AGOA in its present form, reform it, or scrap it altogether?
So the African Growth and Opportunity Initiative, which was voted in by the US Congress about a year ago now, renewed for 10 years. It was bipartisan. Republicans and Democrats both supported it in great numbers, despite the fact that they are at each other's throat on a daily basis. That gives me the impression that there is no chance that any law could come about which could scrap that 10-year provision. However, there is discussion here in Washington about what comes after 10 years. Americans are now aware that Africa is not just a charity case, that it's a business opportunity. They would like to see a larger part of African markets with lower tariff barriers. So after this sort of 10-year period, or during this 10-year period, I think they're going to be looking to much greater levels of reciprocity, particularly in some of the more strong economies like Nigeria and South Africa.
Indeed, and that's proven already to be a fairly contentious issue. Let's focus on China, though. There was a fairly big bunch of that report that focused on shadow banking and the rapid credit growth in China. How big a threat is that to her trading partners?
Well, the IMF has sort of come out on both sides of the risk level on this. On the one hand, they're suggesting that things have stabilized a lot in China of late. We had those problems with the general state of the Chinese economy and levels of concern in China. And that spilled out, obviously, particularly to countries that are reliant on exports to China. Since then, things have settled down, but certainly I think what the IMF's job is to do is to identify some potential risks ahead. And it identifies very high levels of debt in some sectors of the Chinese economy, not least in what's regarded as this sort of shadow banking sector. So people essentially lending money but not being banks themselves. But some of these banks are actually highly exposed to shadow banking. So there is the suggestion here that though China is looking at greater regulatory robustness in terms of its financial sector, and it's doing a good job of that. A lot more needs to be done in order to assure that come the next financial, global or national or regional crisis, the Chinese are going to be in a stronger position, especially, as you say, at a time when corporate debt in particular is at very high levels.
Indeed. One last question for you, Daniel. The fund did express concern as well about the ability of South Africa's banking sector to absorb potential losses. This line did stand out for me. It argued that loan loss reserves are low relative to potential losses. I mean, it does sound as though the fund is calling for South African banks to hold a lot more capital, doesn't it?
It does sound like that, but there is a sensitivity over this because a lot of the big banks in Europe and the United States are complaining to the regulatory authorities saying, we have to have too much reserves now, we can't make enough money out of this. But in this instance, they're suggesting that some of the banks are calculating that their loan losses are going to be fairly low in the future. And the IMF's basically saying maybe you need to look at those calculations and have greater reserves. They're not making an explicit recommendation. I think that's because of the sensitivity of this issue at the moment. But certainly I think they are trying to say to the South Africans, I think you need to look at this in order to maintain a slightly more conservative view of what potentially could happen in the future so that you don't have to then end up bailing out your own banks.
Indeed, and that of course ties into the wider debate around Basel III standards. We'll leave it there for the time being. Thank you very much. That's Daniel Rangers, of course. He's live in Washington. He'll be covering, of course, the annual meetings of the World Bank and the IMF as well in detail over the next couple of days.